Thank you so much for joining us this morning, rather afternoon actually. My name is Srijan. I'm your host for the evening. I'm going to be moderating this session. I'm the co-founder of Finbox. We build technology for lenders. Um, we are going to talk about how a more connected lending is emerging, out of the ecosystem. So we have a very fantastic set of guests today. The topic of the discussion is going to be how different components of the lending ecosystem are going to be connected. So if you look at sourcing today or any of the components of the lending ecosystem, it has evolved quite a lot, in last few years. Earlier we had a monolith where sourcing, decisioning, LMS, collections, everything was done in one. Then this monolith broke down into systems, and now there is a need for connecting these systems intelligently again. Sourcing has evolved where new channels of sourcing have emerged. There was no embedded finance, there was no OCEN, ONDC say 3 years back. Now that has also come up. Decisioning is becoming more and more automated, AI-led, more and more analytical friendly, with a need to sort of integrate with so many new data sources that were not there. Alternate data was not there a few years back. Most of the decisioning was done on traditional data. So there's a lot of innovation that has happened here. Similarly, a lot of innovation is happening on the back office. Back office is becoming more and more agentic. The credit appraisal memos, the CPAs, the ops teams, everything, everybody is getting more and more digitized and agentic. So we're going to explore how all of this gets connected and why there is a need for a system which is more connected. We have a fantastic panel. We have Mr. Sanjay, who is the CEO of Shapoorji Pallonji Group and Shapoorji Pallonji Finance, and he is going to sort of draw in from his experiences of underwriting and looking at ultra large ticket size supply chain finance groups. We have Mr. Ashish, who is going to draw perspective from education loans. We have Mr. Ramaswamy, who is going to draw perspective from rural and semi-urban loans, and we have Mr. Jagdish, who is going to draw perspective from an infrastructure enabler, who is the CTO of Equifax, and who is going to help us understand from that perspective. We'll just quickly do a quick round of introduction from everybody. Would love to. Why don't you start, Mr. Sanjay?
Hello. Hi, I am with Shapoorji Pallonji Finance, and we are an NBFC that does supply chain financing, and we actually focus on co-lending supply chain financing. So that's our core business.
So my name is Ashish. I believe I'm the most credible panelist here because my title says transformation and so does the topic today. In terms of the more mundane introduction, I look at transformation and analytics for the third largest international education loan company in India, which is Auxilo.
Hey, I'm Jagdish Narayan. I look after technology at Equifax. For those that need to know what it is, it's one of the 4 credit bureaus in the country.
Hi, good afternoon all. My name is Ramaswamy and I represent Dwara KGFS. Dwara KGFS is a rural MSME. We primarily operate across 11 states in most of the rural geographies. Around 30,000 villages is what we service. Happy to be here with my very esteemed co-panelists and looking forward to a good session. Thank you.
Thank you so much. So, Sanjay, my first question is to you, sir. I would want to discuss how can NBFCs participate in an ecosystem lending model without diluting governance, risk, and what do you think in terms of what is an effective way of collaborating with other co-lenders in an ecosystem-based lending approach?
I think the question is a bit of an oxymoron because to collaborate, you have to...
You can speak a little bit louder.
When you collaborate, you have to have alignment across origination, underwriting, risk-taking, governance, technologies, AI outcomes we use. It's impossible to have that with any 2 institutions in India. And especially if you're doing something with a public sector institution versus an NBFC, even more difficult. You can align on certain aspects, you can align on certain regulatory things which we all are governed by, and we have, by the way, a very good regulator, a very positive regulator. So that's easy. But I think alignment is almost impossible across the board.
So if you have to describe the ideal alignment structure, how would you go about that? Given today it is sort of hard, but in an ideal utopian world, how would you go about describing an ideal alignment structure?
I think for any lending institution, now we're talking about lending, not technology.
Yes,
I
yes,
think
of course.
the only two things that really matter. Compliance, governance is one, and credit.
Correct.
Parameters, reporting, how we use data, how governance is treated, how governance is reported. Without taking names, I mean, we've had instances where we've done lending and clients have not paid on time. When we reported somebody to one of the 4 rating agencies as an NPA, and the co-lender doesn't report it. So governance mismatch. So where's the alignment? And we both have RBI above us. It happened recently.
So even though the framework exists, so to say, but the interpretation of the framework is different across.
It's not
both
interpretation. I
parties.
think the institutions take a long time to change. They're not ready to adapt. NBFCs are moving really fast. We're using technology very fast. The problem with technology is can you rely on it? What's the governance around technology, right? The governance is very important because if you have bad governance on AI, it's a downward spiral faster than bad credit. If you have good governance, you can scale much harder.
Yeah.
So there's a lot of, all of this to be aligned with a lender upfront. I don't see it happening.
Yeah, yeah. Understood. My next question will be to you, Ashish. From your experience in building digital native platforms, so at Auxilo and even before, what sort of architectural decisions help avoid, silos as you scale? And when I say architectural decisions, it is not just technology architecture. It is about how you design your org, how do you sort of take process architecture decisions. If you could just talk about that.
In fact, I'll focus on, I think not so much on the digital architecture, which I think gets talked about a lot. I think in the new age of doing things, when I think AI is disrupting a lot of the things, one of the key learnings that we've obviously been getting is that how you really run your organization from a structure perspective actually becomes very, very important to what you really reap out of a digital native kind of a system. What I mean by that is there are 3 or 4 components when you really design any solution, right, for a business process delivery. There is tech, there is process, there is data. Now there is obviously AI. And as Sanjay spoke about, governance, right? So I think what we are trying to do, we are a mid-sized NBFC, right? We do not have a lot of legacy in terms of how we used to run our processes, systems, not a lot of tech debt, right? However, I think what we've realized is that until you bring all of these 4 components under a single umbrella to design the process or the solution for process delivery, you will end up creating silos around yourselves. The biggest challenge or the biggest, I get sleepless nights from the perspective that we have really invested a lot on technology in the last 1 or 2 years, but at least, in the next 1 or 2 years itself, will it become completely irrelevant? So I think the single biggest learning that we've got is that you've got to have a pretty flexible core. I think, I'm sorry to use the jargon, but we call it a digital nucleus. So we basically building by bringing these 3 or 4 components together, a digital nucleus, which designs the solutions that you require to deliver the business processes. But we do not really constrain ourselves from a functional design perspective where we are basically constrained by a certain kind of a design, and keep us flexible enough that if technology will change, right? So if the technology changes over the next 2 to 3 years, I can really change the model that I operate to be able to adapt to that technology. So I think it is not so much about what technology I use, but how I remain flexible, what kind of design decisions that I take today so that I can stay relevant in terms of when things change, over the next 3 to 4 years, is the way I look at it.
An example of that? So for example, you talk about future-proofing this, right? So for example, a few days back, what were APIs is now MCP server, right? So give me an example of a decision that is sort of that you've taken that makes it future-proof, just for.
So I think I'll give you an example of education loan, I think, which is very relevant. I think will make it interesting as well. So I think from a regulatory perspective, we've got to ensure end use, right? So we are funding students who are going abroad, and we fund tuition fees, we fund living expenses. earlier, we had to ensure, obviously we still need to ensure that whatever I finance or sanction as a loan today cannot go beyond what the tuition fees or the, the published tuition fees for that course probably is, right? So we had this entire team who used to sit together, build what kind of tuition fees is there. It's changing every 6 months, every 1 year. Now with the advent of AI, what you can really do is, on a real-time basis, I can actually get this information from published market sources very, very easily. Yeah. So I don't have to sit and update this data on a constant basis. So it has become a completely dynamic way of actually looking at this data, and it is critical for me to look at this because I will end up overfunding and probably falling on the wrong side of end use and other RBI compliances. So I think this is one of the key decisions where we thought that why don't we really use this rather than actually having a very static, database driven system. Why don't we completely, utilize this data on a dynamic basis? And I think AI has been able to enable that.
Fantastic. Yeah, that's helpful. I'll quickly switch gears to Mr. Ramaswamy, and then I'll speak to Mr. Jagdish. What does a truly unified lending ecosystem look like in rural or semi-urban finance domain? Because this is a sector where tech literacy is also a challenge. You can design the best possible journeys, but the people, the customers might not understand that, on how to sort of log in and how to do things. So from your perspective of this segment, what does a truly connected system look like?
Sure, thanks. No, let me just start by saying that while adoption of digital may have been a luxury many years ago, today it is hygiene, right? We all know that. There's no two ways about it that digital is the way to go. How much of digital you will be able to adopt and in which areas, I think will get determined by the kind of business that you are in, the segments that you cater to, the markets that you operate in, the literacy of the customers that you spoke about, and all of that. Yeah. So to come into context on from a Dwara KGFS perspective, being a rural NBFC, as I said, if you look at the markets that we operate in, as I said, we operate in deep rural, around 30,000 villages, number one. Number two, the customer segments that we cater to, largely, so a large part of our portfolio is dairy farmers, right, who have cattle and who are pouring milk and have maybe other forms of livelihood, agri-related, small micro entrepreneurs. They could be traders, they could run small shops in the villages, or they could even be running a small manufacturing unit, right? In the villages or in the talukas. So that's the kind of customer segment that we are talking about here, number one. Now, with that, the fact is that can I go entirely digital? Probably the answer is no, not yet at least. And you'll be surprised, Srijan, when you talk about digital literacy amongst the customers, you'll be surprised, right? I mean, most of the houses in the village have a smartphone. It may not be the customer herself or himself. We lend largely to ladies in the house, right, in the household, and to the spouse, of course. But there is a smartphone for sure. It may not be with the customer, but it is there in the household, number one, right? And then secondly, if you see UPI, with the advent of UPI, JAM, and all this, the way the proliferation has happened, every customer has a bank account, every customer is using mobile, every customer is used to making UPI payments, and so on. So literacy is pretty high. It's only about driving that adoption with the customer, which is what we need to kind of push. Having said that, if I need to originate a loan for these customers, I will need to be there physically because what we have to follow is a digitally assisted process. Right? So I still don't have a DIY kind of a engine. Not that I can't build it, but it's just that adoption will not be very high at this point in time because the customers are used to having somebody coming and filling in their application. Having said that, of course, all my processes are digital today, right from origination because it's all app-based. There's no paper that we use. But yes, for the origination, for the last mile connect, I need to be there in the village, which is where I have a large field force, which kind of reaches out to these customers and then kind of originates them. But once I've originated this customer, then I'm able to digitize a lot of the processes through and through. Right? So run the KYC validations, the other validations that I need to run the data, the credit bureau, account aggregator, all of these APIs. We have a full API stack where you kind of run all of these validations and checks. And when we get to the underwriting stage again, there is a bit of mix. So we have business rules which run on these customer data that we have collected. We have a proprietary KGFS score that we call it, which runs on a bunch of parameters and which is self-learning. It's AI ML driven. All of that is there, but there is also a bit of a human element which comes in. Where certain cases which are maybe seen as deviations need to go to a physical person for either a video PD kind of a setup, or at least understand that customer a bit, and sometimes even go for a physical visit. Because one of the challenges that we face in rural, which all of you are obviously familiar with, is the availability of data, especially in the financial data. So for me to understand this customer, I really need to be there to see his setup. If he or she's got 4 cattle, what is the kind of produce that is coming from the cattle? Even if you go to the milk pouring centers where they pour the milk, milk receipts are still not totally digitized. So there's a lot of physical paper which comes through. If I go to a shopkeeper, then I need to understand what is the kind of sales. A lot of this is declared income or declared expenses even today, which is where I run a lot of proprietary algorithms to try and ring fence this income and expenditure to ensure that there are no outliers there. Because I have data now, right? I have enough data to know a farmer in X location, what's the kind of produce that he's likely to get, or what is the kind of milk pouring capacity that they will have, and therefore I can assess if there are any outliers. So within those ring-fenced outliers, I can actually operate and have a fair assessment of his income expenditure, number one. Number two, on the intent side, of course, as I said, there is bureau track. I can look at it, I can look at his banking habits, all of those things I can do, which is all digital. So using that and a combination of a bit of physical touch, I'm able to underwrite the customer in a matter of maybe a few hours or maximum in a day or so. And then disburse the loan. Of course, on the disbursement, again, then because there are bank accounts now, the disbursement is always into the bank account. So all those processes are digitized. We do a penny drop check to ensure that the account is valid. All of those things happen. So net, if you see, Srijan, the point I'm trying to make is it's going to be a mix, right? While there is high amount of financial literacy and we are obviously leveraging on that, today, incidentally, on the collection side, because after the loan is disbursed comes the collections part. Again, a bit of physical touch happens, but 40% of my collections today are digital. It could be assisted digital, or it could be the customer themselves paying through a TPAP, a UPI app. But yes, 40% of my payments which come in are digital actually. So so it's a mix of physical and digital, and that's where I think it will remain for a while. It also gives me the ability to underwrite this customer better. Once I've acquired this customer and he's a customer of mine, then obviously it changes the perspective completely, right? Now the customer is with me, I have a strong track building up on this customer. So how I would renew or how I would upgrade or upsell to this customer will be very different compared to how I would acquire a new customer. Yeah.
Fair. And then moving to Mr. Jagdish, how do you think the role of credit bureaus is evolving in creating this connected single view? So you can talk about what it was a few years back and how it is changing and what do you see going forward?
Right. So fundamentally, it is all about data, right? Now, when we say connected systems, connected whatever, it's about how easily the data from one end can flow to the other, and how do you bring in the data across multiple patterns in one place? And that's really where the credit bureau comes into picture. So while every credit institution would have its own data, now if you want the enriched data across all of different institutions, across different domains, across industry, across geographies, across patterns of people, that's really where the credit institution the bureaus come into the picture, right? And to be able to get you that kind of propensity, right, from the propensity to borrow, to repay, and the whole works really across different products, across different segments, and all of that is really where the credit bureau comes into play. And now, in a new connected world where we're talking about disbursements of at least small ticket sizes happening in near real time, whether it is BNPL, whether it is, or just small ticket personal loans, whatever, happening in near real time, that's where the the real-time flow of the data from one end to the other via the credit bureaus plays the most significant part. And obviously, if you, and I have taken this example in the past as well. So if you're in a BNPL example, it's like somebody in the middle of a store buying a TV, asking for a BNPL at that point in time. And at that instant, from the merchant to the lender to the bureau and back has to happen in real time. That's the kind of connectivity that we're talking about in these kind of scenarios, right? I mean, most of the other lending still happens, semi-digitally and semi-physically, and there is still some level of patience, to wait in front of an app for at least a minute or two, but not in front of a queue of 25 people in a Chroma store. You don't have any patience at that point in time to wait for any length of time to get that transaction cleared out at that point in time. So that's really how the thing has evolved from being a typical, home loan erstwhile model where you send a whole bunch of documents and then you get back the data after some time and etc. All that is all past. So everybody talks about getting data in. How many transactions can you do respond in less than 1 second? That's the
especially on festive seasons and on.
Don't even go there because that's a problem statement. Festive seasons is in India very regional, right?
Yeah.
When there is Onam in Kerala, there's nothing in Punjab at that time. And when there's Puja in Bengal, Gujarat is okay. So there is a festive season in every part of the country every other few weeks.
Yes, that's very interesting.
And the pattern changes drastically during that time. It just dramatically changes at that point in time. And that just throws the whole equation out of the window. So that's a different ballgame altogether that we need to deal with all the time.
Right.
So that brings in those specific region-specific or segment-specific requirements into play, which have to be dealt with as it comes along. And we have to be able to provide those sort of cuts or those sort of views of the data at those points in time. That's really how the connectivity works.
Fair. On the topic of data and sort of AI and analytics, my next question will be to Mr. Sanjay. Sir, so in longer tenure loans, in higher ticket size loans, what sort of data innovation are we seeing or analytics or AI innovation are we seeing when it comes to underwriting, when it comes to process innovation?
There's a slight difference in when we do smaller ticket and larger ticket. Any loan less than 1 lakh is not recoverable. Doesn't pay you right it off.
Yeah.
So recovery cost is a lot more.
Correct.
Our lending typically 30 crores, 50 crores, 100 crores. So the analysis has got a lot more human in the loop.
Correct.
For sure. Because the loans are much larger, because these are largely corporations that are rated, you have more data available. And because you have more data available, you look for early warning signs.
Okay.
And I'll tell you the challenge that we face. And this is again, I'll give you a real life example where we pick up 7 sutras of RBI says you have to pick up about 42 points of data. We pick up about 160. All sorts of data about directors, about shareholders, which is not required. Recently, we picked up, everything was fine. One day before disbursement, a shareholder, not even a director, not a KMP, shareholder came on RBI's fraud list.
Wow.
Now, nobody would pick that up. And the night before it came and we stopped the disbursement. Another example is that we run very extensive EWS systems, early warning systems for this thing. And early warning is exactly that, early warning. And the credit team picked up a lot of data, which pattern, again, coming back to humans. AI was used, but she said, this doesn't smell right, and she stopped the lending. RM comes and starts doing somersaults in front of her and starts crying and everything, and she said, nothing doing. Both cases got downgraded by rating agencies in 2 months. So when you're doing large-scale lending or institutional lending or longer duration lending, the tracking and monitoring and early warning systems that you design, and not the tick-the-box early warning, but early warning that are suited to your business. Whether you're doing supply chain, there are different warnings. If you're doing term lending or you're doing gold, they're very different this thing. And it is very holistic. It is not just to the lender or to the institution, but all around.
Yeah. And how frequently would you see this portfolio from an early warning perspective? Is it like a daily thing? Is it like a weekly thing?
It's ongoing, it doesn't stop. The only thing, the triggers are different. So if I'm tracking, let's say someone's CIBIL score, then CIBIL only updates every once in 15 days, I'll check that. RBI may come up with an FIU list once in 7 days. So it depends on the frequency of data that's coming. So the API, we've got multi-agents that go pick up the stuff, right? So the timeline depends on the data I'm tracking. EPFO data, we pick up all sorts of stuff.
Understood.
So it's a function of the availability of the refresh of the data.
When we were chatting offline, you also mentioned you have a large in-house AI team who sort of works on these things. So can you talk more about, some interesting ways in which your company is using AI for problem solving?
See, AI, we've found that we've been using AI for a long time now. So AI is no longer a new buzzword. For us, it's very old. You can shorten a process. You can do great analytics, you can do performance analytics, industry analytics, you can do all of that. But the final decision is always made by the human and will always be. Second thing, when we're doing large lending loans like we do, there has to be a connect with the promoter, with the CFO, go to the company. Like you said, you go and see the hygiene, whether this cow can produce milk. We go and see whether the factory is actually working or is it just some shed. So there's a lot of manual work required at origination for sure, and in the end. In the middle part, which used to take about 3 weeks, now we do it in about 4 days.
Oh, wow.
So the tech has made it faster, but I think the biggest learning, we focus not on the tech, but on the governance of the data.
Right.
If data is misused by us, or the data is not governed correctly by us, or the data that we give it to our lender, co-lender, I think that's a huge risk. And most institutions today are not yet aware of the risks that we run with the new DPTP guidelines and governance guidelines. I mean, we've got a team that actually, we have a dedicated team only on governance. She's a PhD in governance, and without her, nothing goes through, no product goes through. So we crossed AI. AI is gone. That's yesterday. Now we're moving to the next level of how we use AI and how you use data and how you consume data and how you share data with co-lenders. So there's a lot more to AI than just some agentic flow.
Yeah. Fair. So Ashish, now that we are on the topic of AI, and especially for retail loans that you power, the expectation from the customer is more STP, more digital process, and a lot of decisioning also has to be some model driven or some AI driven. How do you ensure fairness? How do you ensure explainability? How do you ensure governance within this ecosystem?
So I think I'll again take an example from an education loan scenario itself. And I think one of the things that we are very actively looking to build our solutions and processes around is the digital public infrastructure, right? The solutions and the tools provided by DPI. And I'll give you a very interesting example of how that is happening. I think one of the biggest risks or frauds that can actually happen is the mark sheet fraud in our business, right? So we look at the academics of the borrower who is going abroad, and there could be scenarios where the borrower is actually using a loan to as a means to immigrate to another country, right? Where the real intention to study is really not that great, if I can call it that, right? It's not about employment, it's being able to immigrate to a new country. So I think for us, the mark sheet fraud was actually very, very, interesting, and with the changes happening in geopolitics, etc., I think the business is shifting quite fast from one country to the other. What we realized is that if you look at the DPI DigiLocker solution, right, it allows you to download authentic mark sheets from a very large number of institutions which are already on it. I mean, for example, majority of the students that we end up funding are in the age bracket of say 20 to 25, which means that they would have actually finished their undergrads in the last 4 to 5 years, where the availability of this information on that medium is very, very high. So I think just look at how you can actually build trust, assurance from really utilizing what is already out there rather than having 10 different checks, that you might be doing, which you might still do, but you can place a lot of reliance by building your processes around something which is already very authentic and available. And I think naturally I think it will be obviously looked at very positively from a regulation and an assurance perspective as well. So I wouldn't say this is an AI sort of use case, but I think more from a building the assurance and the compliance around how you look at and build some of these things. And I think we are looking at DPI and building our processes around it in a big way to actually meet that objective.
Fantastic. And would you also then, for example, in case data is not available in DPI, you would also triangulate this from other data sources? For example, build a profile. If someone got, say, 80% in 10th and their 12th is not available, then it's highly likely that they would be around that ballpark, right? So there's some element of pattern recognition there.
Absolutely, I think, and not only as you take a right example, I think in academics, but in a number of other areas like which we assess from a borrower profile. So I think our main borrower is the student, which we end up underwriting to a very small degree, right? Because I think the student could be a fresh graduate who doesn't have a lot of credit history, if you like. But if we triangulate a lot of this information for the parent or the co-borrower, I think there are a number of such areas that we are actually looking at, which are not specific only to education loans as an underwriting model, but I think can be utilized with a large number of other industries as well. So yes, we are doing a lot of that.
Fair. My next question is to Mr. Ramaswamy. So in this segment where Dwara plays, is there, do you see unavailability of a lot of formal data? And if yes, the core sort of credit decisioning or any sort of a credit engine, be it AI-driven, be it RPA-driven, or be it ML-driven, data is the lifeblood, right? So in segments where a lot of formal data itself is not available, first of all, it's a question that, is it changing? Are you seeing more formal data availability? Of course, DPI is there. And second question, in case the data availability is still a problem, how do you bridge this gap?
Yeah, absolutely. No. So let me first start by saying that as part of the origination process, when my field officer is visiting the customers, firstly in rural, we spend a lot of time at a household level collecting data, not just at an individual level. Because in the rural segments, I think getting an understanding of the household is very important rather than just individual, because the impact during downturns is pretty significant there, and the entire household gets affected, right? So it's important to understand more of the household in the rural context as compared to maybe in the urban context. So as a part of our process, and we have kind of perfected this pretty much over so many years that we have been in existence now, where we are able to kind of meet up with the household, spend time, collect a lot of data points. So we have a process which we call as the FWR. It's called the Financial Wellbeing Report. This is proprietary that we have built working closely with IIT Madras actually many years ago, and we have been kind of refining that model as we go along. But we use that means to collect a lot of information about the household. A lot of it is stated, as I said, definitely. But now, with the hindsight of having so much of data with us, we are able to kind of, as I said earlier, ring fence it, remove the outliers and do all of that. But yes, there is a lot of informal data which we collect as part of the conversations that we have with our with the customers. And today we are seeing formal data coming in. As I said, we have connectors with the bureau. Of course, is one very important source of information that we use and leverage upon. Account aggregators and so on is there, right? So we are seeing a lot of data coming in from that perspective also. But so it's a bit of a combination of both. Information collected from the customers through discussions and some bit of the public infrastructure data which comes in. Once all of that comes in, we have built, as I was mentioning earlier, we have built something called a KGFS score, which considers a bunch of variables. So we have done a lot of backtesting. We also have a full-fledged analytics team and a AI setup where we have done a lot of backtesting on a lot of these variables to see what is the correlation and how, what is the impact on portfolio behavior and quality. And we have now developed a score which kind of ranks the customer on four scores actually, from a very good to a kind of a low, right? Very good, good, moderate, low. And our underwriting rules, our risk parameters are completely based on the scoring, right? And added to this dimension is the fact, as I was saying earlier, whether the customer is new to the organization from a lending perspective, new to credit itself, or an existing customer of mine. So if you put this in a kind of a grid, we have kind of built underwriting rules which are kind of, basis this kind of grid that I was talking about. That helps us to kind of really underwrite the customer reasonably well. And obviously we continuously keep tracking the portfolio behavior to see what tweaks we need to do from time to time on this model. So that has helped us to actually ensure that we are able to manage this entire process tightly. Yeah.
Jagdish, on the topic of bureau data, while the bureaus are the custodian of data, there are so many new products that bureaus also keep on building, be it in forms of collection scores, propensity scores, or any of these new models for different segments, right? So what is something that, let's say you are working on, which you're excited about on the AI side to sort of help the ecosystem use the bureau data well?
Yeah. Since, like you rightly said, the bureau primarily is not just about the raw data, it's about interpreting it the right way, right? And when you try, and the scores are one way of interpreting the data to give you some sort of indication of what the customer is likely to do or not likely to do in different scenarios, right? Now, whenever you get into that, in that space of using data to come out with a likelihood of something happening or not happening, by its very nature, it lends itself to an AI-based sort of activity, right? It's a question of course, being a bureau also comes with a huge responsibility that one single number decides the lives of a lot of people. And in the case of large commercial loans, perhaps even to some extent, even the economy, in fact, to some extent, right? So obviously, while implementing or incorporating any concept, it has to be tested so often, so thoroughly, so comprehensively, and that's the requirement of the regulator as well, that before any score gets introduced, it has to be very, very thoroughly tested. So yes, by its very nature, the bureau scoring process lends itself to be AI driven and based heavily on that. But yes, it all gets introduced in a very graduated manner so that it's not just like you rightly said, not just putting in something for the heck of it. The governance around it is the biggest critical thing to ensure that whatever comes out at the end of it is better than what was there before it was AI driven. That's the whole criteria on which it is done. So yes, we do it, but it's on the basis of that.
And just a follow-up question on this, that how does the credit infrastructure strengthen, trust, auditability, systemic oversight, and how do you really promote explainability and systemic oversight with bureau data?
Right. So it's exactly the same thing again. It's about the accuracy of the data. So if the data is accurate and reliable and consistent, then you know that it can be used to build the right behavioral models to understand what's happening better, and hence do more informed lending decisions and things like that. So, so what you said is fundamental, because I think practically the whole thing about a bureau data is about trust, really.
What do you think will be the percentage of people where data is wrong in bureau today?
So it depends on on multiple factors, frankly. It depends on the quality of data that comes inside.
Yeah.
Well, it's getting better as systems are getting more digitized, etc. But there's
a push for more frequent data pushes.
That's the important thing.
Yeah.
Too. One is the correctness. One is the frequency or the current nature of the data. It could be correct but yet late,
Right.
and then it's no good because it's too stale by the time it comes in. So it's a combination of these things, and of course our own ability to process it correctly. which typically adds the overall trust factor to the whole data really.
And I think it's also awareness about what bureaus are to the general public, because once people are more aware that this is a score that really matters in my life, they will also be vigilant to look for inconsistencies and provide feedback more actively. Because I'm always curious to understand what percentage of people would actually go and correct their bureau score. I mean, this bunch is a financially literate bunch, so they would basically know and they would take the initiative of correcting it. But not a lot of other people would do it, right?
No, not really. I mean, I don't know if I ever visited a bureau, or rather looked up a bureau score before I first wanted to take a loan.
Yeah.
So I always heard the term credit history in my life, but I never bothered about figuring out what my credit history was until I needed some credit at some point in time. That's a ground reality. That's a hard reality. So yes, it's important that people understand what credit history is about, and hence what their credit history looks like, and what needs to be done to make it better. That's an awareness that needs to go in at multiple levels, really.
Sure. You want to add something?
No. So you'll be surprised. Rural customers are highly aware, right? Highly aware of what credit score is all about, what a good credit track and behavior means, because they are used to lending, right? Borrowing, right? Every rural customer or household will be running at least 3 loans, 4 loans at a time. Yeah. Correct? Of course, there is the issue of over leverage and all those other things which happened, which is what the microfinance industry went through. But having said that, there is a lot of understanding and awareness also on ensuring good credit behavior, ensuring repayment on time, so that they know that the next loan is possible.
Fantastic. That's good to know. Yeah. Cool. I think, are there any questions in the audience? We're just about time.
Hello, this is Rukmini. I come from Prime Equation. So my question is to Ramaswamy. I so liked it when you said that today technology is hygiene, not something that can be had. So coming from there, when you say there's so much data you've collected, it interests me especially that you're working on the rural space, that you're doing on financial inclusion. So that is an area where not much of data was available. When you say that so much data has been building up, my next question to this is, have you been trying to analyze, based on the given data, what kind of portfolio analysis can be done geographically, as well as the type of customers that you have? Also, the next step is any kind of AI. Have you been thinking on that?
Absolutely. No, thank you so much, Rukmini. Yeah, so you're absolutely bang on, right? There's a lot of work that we do on the data, right? So today, if you see, we operate in 11 states, mainly in the south, east, and the north. And some of these markets are tough markets. I can talk about a couple of markets. I was just mentioning to my co-panelists here, Bihar, Uttar Pradesh, 2 particular markets, even Chhattisgarh to some extent, some markets which are very difficult for us, for everybody as an industry phenomenon. It's not peculiar to us. So we do a lot of understanding of customer behavior, portfolio behavior by geography, by customer segment, by bureau scorecards, multiple cuts we do, right? And whether the customer is new to credit, new to the company, or a renewal customer. So a lot of data cuts we do. There is a full-fledged risk team, obviously, and a governance team which works on all of these cuts. And a lot of our underwriting policies are tuned to geography, right? So the way I would lend to a customer in Bihar, for example, as an example, is very different from the way I lend to a customer in Tamil Nadu, right? And that is coming through very clearly, and that is where this data that we have collected and the understanding that we have of this customer that we have built over a period of time really helps us to kind of refine our lending policies, underwriting parameters, and therefore hopefully improve the portfolio quality. So that's one. Even ticket size, for example, right? So there are a lot of cuts that we do to be able to assess whom to lend to, what should be my lending, what should be the amount that I would lend, what is the rate at which I will lend, and all of that. Then there is also, you talked about AI. So we have a couple of pilots running now on AI, actually, agentic AI. One is, because I mentioned that there's a lot of stated income and data which comes in, there is also a process where certain cases go through a human check. Now we are trying to see if we can use a bot to kind of do those checks, right, and take away the need to have a human element there. So there's a pilot that we are currently running on that, number one. Number two, the other big use case that we already started and we are seeing some good results, and hopefully we'll move from pilot to scale, is using them at the contact center. So because again we are talking about 30,000 villages, so many households and so many villages, there is always a limitation to how many people I can put on the ground. So we do a lot of work to reach out to these customers through our contact center. And now we've just, as I was mentioning, we ran 2-3 pilots. We use the contact center for two things, apart from the inbound, of course. I'm talking about the outbound here, where I do calling for collections and actually push a digital link and collect digitally. Or I have a pre-approved program, which is again run basis the data that I've collected from customers, where I can offer pre-approved loans of small tickets to these customers without having to go through a lengthy process. For both of these, we have done pilots successfully on using voice bots, right? Voice calling agentic AI, and we have seen some good results there, and we will hopefully be scaling that up in the next year. Yeah.
Any more questions? Here in the front.
Hi, this is Upasna from Aditya Birla Capital Limited, and my question is with Mr. Ashish Gupta. So, hi Ashish. So, you've talked about a lot about the education loan. So, I wanted to understand, with the geopolitics going around and the people who are sending now the kids out have really come down. So, how do you see the trend, and how do we actually predict, and how do we, enhance into that area or genre of education loan? So, if you can talk about that.
Ashish, I have a question linked to that one only. I'm Ritu from HDFC Bank. I wanted to check for the education loan. In the current market, what are the lending apps available where the non-traditional variables in terms of the borrower's education pattern, his income, is there something available on an AI digital platform?
So I think I think the way the business is evolving, there is no question that we have seen the international education loan market undergo a massive change, right? There is no question about that. What we are, however, seeing is that what we talk a lot about that, I think US obviously was the primary, country where a lot of our students used to go traditionally. I think that has been the case for a number of years. It has the most mature, the most deep market from an education perspective, especially from post-grad STEM, right? However, I think the trend that we're really seeing is that while US is coming down in terms of interest level, there are a whole lot of other countries, not at the same level perhaps, but I think there are a lot of other countries, there's a lot of interest among students to explore a lot of other geographies. For example, Europe, for example, becomes a very, very important market as well. UK always has been. So I think if you look at the overall market, it splits basically into two parts, the English speaking, right, and the non-English speaking. So you are actually seeing a lot of interest, which will naturally take time to convert into business over time, but you are definitely seeing a lot of interest in the non-English speaking countries as well, with students wanting to really go across to those countries as well. Can I say that it will compensate for, it is compensating for, what we've lost, or is, the reducing trend on? Probably not. But then I think we are very, very, keen on India as a market, with so many of the foreign universities really coming into India as well. We believe that it is only a matter of time before India can actually compete with or become a bigger market from an education loan perspective than the overseas market itself. It's a journey. I think we've started the journey now, but I think we are very, very confident that I think over the next few years, I think India could actually become a much larger market than the international market itself. I think coming to the point about, I think alternate sources of data, I think on the traditional underwriting, I think what we've got to understand is that we are underwriting future of the students, right? We are not underwriting the past. The only indicator of future success is how the students might have done academically in the past. So I think the whole education loan industry does not hinge on discounting a lot of the past, right? So we have to continue to believe that, with whatever challenges there are, what that will lead to is perhaps the employment cycles getting extended. But these are people, these are students who are highly qualified, going for very good courses. So perhaps the time that you might take to really land a job might increase, but eventually you are the segment that will eventually be favored for, getting jobs as well. So we are not overly worried about it, that it is going to have a massive impact from a business perspective. I think we remain very, very positive that internationally, as business kind of stabilizes, I think we will be able to bring that up from a domestic perspective as well. So we are very confident about that. I hope that addressed the question, actually. Thanks.
This will be the last question that we'll take.
Hello. Hi. Good afternoon. Myself, Pawan Goyal, and thanks to the panel for insightful discussion. My question is primarily to the lenders like Sanjay ji, Ashish ji, and Ramaswamy. We talked about all this structured data which is available through bureau and other platforms like account aggregators. But a lot of insight is sitting in the unstructured data. For example, it could be audit reports of multi-pager, could be the admission documents, could be the last mile conversation which are happening between the borrower and the lender for all the cases. Are there any kind of tech and transformation which is being used to probably leverage this unstructured data like PDFs, audio, videos, whatever is, the conversations are happening, whatever is happening, I would like to learn.
A lot has already happened. With AI, you can take data and create actionables, which we are doing very actively. But then you take AI, and every corporation is sitting on massive amount of data. If you use knowledge management systems that are AI enabled, you can pick data in multi languages, in different formats, in diagrams, in videos, in different languages. And if you put all of this together, you can create actionables that can help you make a decision. We still need a human to make that decision. But all this is already available easily, can be built by you. I'm sure there are tools in the market. We've already built these systems. We use them regularly. And we find that this saves a lot of time. And the actionables actually create great accountability as to who in the organization this is targeted to. Is it the product team? Is it the sales team? Is it the front end team or the back end team? So yeah, it's available.
Yeah, so, no, you're right. And I did allude to this as part of my conversation. There is unstructured data which we collect, and we use that actively for our underwriting decisions. So, as I was saying, the KGFS score, one part is just the credit bureau score. That's just one part, which must be having, I think, 20% weightage in the entire scoring. The remaining 80% is what information we collect from the customer in the household. It could be education, it could be the assets that they own in the household, it could be the duration of stay, all of those things, right? There's a bunch of parameters that go into that scoring, and not all of that is validated information in that sense, right? So it is collected information, stated information. So yes. Yeah.
Thank you so much. Now I would request Mr. Srijan Nagar, co-founder of Finbox, to please give away the token of appreciation to all our panelists. First up, in no particular order, Ramaswamy Subramanian, Deputy Chief Executive Officer, Dwara KGFS. Then we have Jagdish Narayan, CTO, Equifax India. Then we have Sanjay Hinduja, Managing Director and CEO, Shapurji Palonji Finance. Then we have Ashish Gupta, Chief Transformation and Analytics Officer, Auxilo Finserv. Now I would request Mr. Shashank to please come up on the stage to felicitate Mr. Srijan Nagar, co-founder and Finbox, for successfully moderating this conversation. Gentlemen, I would request for a group picture. Please come ahead for a group photograph.